Welcome back. It has been too long. I can't believe how fast 2023 is passing by. I'm a little overdue, but excited for our next Money Mastermind series. This is Steve Stern, certified financial planner and owner of Able Financial. Let's catch up and talk about the markets and share thoughts on what has happened over the past several years and where we see things going forward. But first, a quick Stern family update. The big news of this spring has been our daughter's graduation from preschool. I can't believe how fast our kids get older. I'm so proud of Riley and the woman she's becoming, and we're excited for her to enter kindergarten. Let's dive right in. Today, we will review the market into the first week of June, discuss the tale of two markets where certain sectors are hot while many others remain cold. This is what we call the Goldilocks market. We're going to discuss the rise of artificial intelligence and companies that are benefiting, and finally look at what the economic indicators are pointing to for the rest of 2023. Now, looking at the major stock indexes, we have quite a contrast to what we saw in 2022. The technology-heavy NASDAQ index is leading with growth of 27%. The S&P 500, which is the 500 largest companies in the US, are heavily influenced by those same technology companies. The index as a whole is up about 13%. If we look at this MSCI EFA, this is international companies. International companies are also off to a strong start, up 11%. Whereas unfortunately, the small cap index, the Russell 2000, is only up about 6.5%, and value stocks, which is typically the Dow Jones index, is up about 3%. Now, a lot of times when we talk about the market, we talk about either the S&P 500 or the Dow Jones. So is it a great start to the year, or is it pretty much a flat start to the year? It depends on what individual companies you're looking at. Looking at the index level or at sectors, you can see that technology, consumer discretionary, and communication services. These are your companies like Amazon, Facebook, Netflix, Google. These are the companies that are pretty much carrying the market. If we look at every other sector from healthcare, consumer staples, utilities, these are defensive sectors. They're negative for the year, whereas everything else is pretty much flat or negative. Finally, gold is having a strong start to the year, up 7.5%. Natural gas and oil, which were the best performers last year, are down significantly, whereas bonds, slow and steady, wins the race. So they're slowly increasing throughout the year, but not a bad pace and a good recovery from what we saw last year. However, we're starting to see weakness over the past month. Most categories are negative here. Now, let's dive deeper. Last year, we talked a lot about midterm election years and how they often lead to big corrections. However, we also pointed out that the recovery typically happens starting around October. 2022 was no exception, as you can see from this chart, what typically happens. Now, many of the worst performers through the first 9 months of the year in 2022 have since been the best performers since October 13th. You can see international, large growth, or technology stocks have been very hot since October 13th of 2022. However, this year has so far been defined by the explosion, or many would call a mania, of artificial intelligence with the release of OpenAI's ChatGPT or Google's Bard. Let's dive deeper on that topic. Many stocks are still struggling in 2023 as the Fed keeps the pedal on the brakes. Artificial intelligence and technology stocks are exploding once again. As you can see, the top 30 stocks are dominated by semiconductors. Think NVIDIA, who make GPUs, which are chips used in AI, and other semiconductor and software companies. These are also the companies that had the worst 2022. NVIDIA was down 50%. Meta, a second best performer this year, was down 64%. Tesla was down 65%. AMD was down 55%, and Amazon was down 50%. These stocks are pricing in the hope that For example, GPU, semiconductor demand, which are used in AI, will explode. That's why NVIDIA is doing so well. They're pricing in that companies will be able to extract more productivity out of fewer employees, and because of that, profit margins should increase. Finally, let's take a look at this typical cycle of a mania. While 2022 was a challenging year, it's important to put the year in perspective. In 2017, the market was up 22%. In 2018, we had a minor correction at the end of the year. The market was down 5%. In 2019, the market again was up 31%. 2020, despite the pandemic, the market ended up 18%. 2021, with all that government intervention, the market was up 29%. After those 5 years, we've averaged 19% per year in just the U.S. large cap stock market. Many other parts of the market were up significantly more. So we were due for a correction. After the correction in 2022, where we were down 18%, nearly 30% at its lows, we are now averaging 13% per year, which is closer but still above long-term averages. It's critical to be wary of traps in the market where we have a big correction but remain above long-term averages. While we may have returned to the normal phase, as you can see, the stealth phase of the market returning, a quick bear trap, think 2018, media attention, enthusiasm, greed, delusion, a new paradigm, and then we have the bear market. We had a nice recovery. We could potentially be here, a return to a new normal. But remember, the fact is we're still unwinding massive government intervention. It's very possible that we have one more large drop where we have fear and despair and eventually return to normal. I'm certainly hoping we don't have to go through this. I'd love for us to be back into a normal phase. Maybe the hype of artificial intelligence can carry us forward, but only time will tell. Let's run down the economy in 60 seconds. First of all, small businesses are the engine of our economy. Suffice it to say, they're not optimistic. We are approaching recession territory. Moving on to the consumer. Revolving consumer credit is at record highs. This is not looking good. Consumer revolving credit is credit cards, not mortgages. This is going to put a strain on consumers as interest rates remain high. Student loan payments are expected to restart. Not a good sign for an economy which depends on consumer spending for growth. The ISM Service Sector Index. This is a survey of purchasing and supply executives in 20 industries such as legal services, entertainment, real estate, finance, and insurance. Levels below 50 mean contraction and typically lead to recessions. This slow decline is reflecting the rising rates from the Fed. Similar to the services and index, this measures manufacturing activity. Again, below 50 often leads to recessions. You can see we are quite far below 50, heading towards recessionary levels. And finally, the U.S. Leading Economic Index is one of the most widely followed and accurate predictors of an upcoming recession. Every decline going back to the 1960s has been followed by a recession. This index is made up of 10 components. It includes some of the categories we just looked at: employment, manufacturing, housing, consumer sentiment, stock prices, and credit. The current forecast is for a recession to begin mid-2023. Somewhere around the world, there's bad news, and there's always another catastrophe waiting to happen. China might invade Taiwan, and the Federal Reserve can surprise us, but I'm optimistic about the future, and our economy always perseveres. With that in mind, here's my steady advice. Focus on what you can control. Stick to your financial plan. We got lucky we avoided a debt crisis, but recession still looms. Success is broad diversification, not market timing. And as always, call us if you're concerned. Looking forward to the next Money Mastermind. And until then, have a wonderful summer.